Good day. My name is Francois Viruly, and this input will introduce the property cycle and the implications for housing markets and housing finance. Now, property cycles influence property markets, and to analyze property markets, we need to understand how they work. Economic activity and property markets fluctuate, often in sync with one another, and this became evident in the global financial crisis in 2008, where a sharp downward phase of the property cycle affected the economy. This crisis also illustrated the social outcomes of property fluctuations. And since then, policymakers have become more cognizant of cycles and have come under pressure to put in place mechanisms to avoid property booms and busts with the associated negative social consequences. Now, to understand and interpret property cycles, it's important to recognize the exogenous as well as the endogenous forces that influence them. It is also important to distinguish between the different cycles that influence property markets. For example, this would include the investment and development cycles. Now, the exogenous influences include the macroeconomic factors such as GDP, inflation rates, and interest rates outside of the property market. These forces have a profound impact on investor sentiments, and they indirectly affect the demand for space. Now, on the other hand, the endogenous forces within the property market, now, they influence the way the property market responds to market signals, the exogenous signals that we just discussed. The property market responds to that. And the boom and bust scenarios that property markets are known for are affected by market characteristics. Property markets are characterized by high levels of inefficiency, poor data, and they're also well known for their long lead times and the time it takes for the market players to alter their decisions to reflect changes in market conditions. Property development involves considerable time, and these are time lags between the start and completion of a project. So it can take time for demand and supply to move into equilibrium. Now, the inherent inefficiency in property market transmission mechanisms influence the phases and shape of property cycles. And they comprise several phases, from recession, recovery, expansion, and ultimately contraction. Now, property cycles are also defined not only by their phases, but by their length and their amplitude. Now, during the recessionary phase of property markets, the market operates in an oversupplied scenario with insufficient demand. Demand is low, the economy is not doing well. And it's often driven by poor economic growth prospects in the real economy. Then, during the recovery phase, we see an improvement in economic growth And that improvement in economic growth results in an improvement in household balance sheets, which in turn leads to a rise in the demand for space. Now, as the market starts mopping up excess space, vacancies start to decline. And this results in a rise in rentals and property values. The expansion phase, on the other hand, is driven by declining vacancy rates, improved prospects for capital growth, and an increasing number of investors entering the market. Conditions are better, investors start entering the market, starting to look for prospects. The expansion phase also provides important signals to the development market to start supplying the market. Conditions improve, developers start responding as well. Now, the time required between the inception or start of a development project and its ultimate delivery can span numerous years, which means that supply often reaches the market at the point when demand for space has started to decline. In other words, supply enters the market is already on its way down, supply enters too late. And this development activity results ultimately in the contraction phase of the market, which is characterized by supply exceeding demand, declining property values, and ultimately a decline in investor confidence. Now, the steepness of the contraction phase of the property cycle will be influenced by, for example, the weakness of the macroeconomy. It will be influenced by investor confidence and as well the degree to which the development market oversupplied the market. So what happens is that we have this strong downward phase determined by conditions in the market, which influences the progression of the property cycle. Now, while the point is often made that property decision-making is primarily influenced by location, I think that there's a growing recognition that timing matters. Now, for the investor, acquiring a property at the wrong point along the property cycle can have a significant impact on results. And I think this is particularly true in the short term, especially for a speculative investor. For the developer, timing can determine the difference between the success or failure of a development, with a development entering the market at the wrong time. Now, forecasting the stages and timing of property cycles is a complex exercise. It requires focusing on the present market conditions, whilst also anticipating the future macroeconomy, the parameters that will influence the market. And typical examples include GDP growth and ultimately the decisions made within the property market. Now, traditionally, there are two ways of forecasting markets. The first approach focuses on the performance of the economy, and it is based on the proposition that there's a strong relationship between economic growth and the demand for space. And that is true for both the commercial and the residential property market sector. As the economy grows, one would expect that one needs more space. The second approach is based on the view that vacancy rates move around a natural vacancy rate around an average. And this approach assesses the degree to which a market deviates from its natural or equilibrium point. So, over time, the performance of property markets is influenced by social and economic structural changes. Not just GDP. It is what the economy looks like, what influences it, the mega trends. For example, in South Africa, long-term cycles reach their peak every 20 years or so. Examples of long-term structural changes include the demand for space, brought by decentralization. The movement outside of cities had an impact on the cycle in South Africa. Another example includes the growing demand for smaller houses, for smaller household units. In other words, families that used to live in one house now possibly live in 2 or 3 houses. That influences demand and cycles. So such structural changes can stimulate property booms in specific localities and in market segments. So at any time, different sectors of the property market will be located at different phases of the property cycle. Imagine a train going through a station. All the carriages come through at different times. Different segments of the market reach a point on the cycle at different points. Property market cycles can have critical social outcomes. It's not just a financial story that plays itself out. The deceleration of economic growth in the United States in 2006 slowed demand in the property market. And this altered market sentiments that had relied on rising property values to maintain affordability. As the recession kicked in, households came under financial pressure and ultimately defaulted on housing loans. This in turn increased the risk associated with securitized mortgage loans, causing the financial crisis and ultimately the bankruptcy of some of the largest financial institutions in the United States. This in turn influenced the abilities of banks to continue supporting investment activities, and it had a severe negative impact on both the economy and social outcomes, with households not being able to borrow. Now, this particular case illustrates the need for careful monitoring and managing of property cycles, which reserve banks across the globe are increasingly aware of. The characteristics of property cycles is also influenced by the maturity of property markets. Now, market maturity reflects the availability of data, the rules of the game, and the integration that exists between property and financial markets. That integration is important. So the level of market maturity varies considerably from one African property market to the next, which also means that it's difficult to generalize about property markets and cycles on the African continent. It's a function of the maturity of markets and how they perform. Market maturity influences the way property markets respond to changing macroeconomic conditions, and as we discussed earlier, other forces. When market transparency is low, and information flows poorly, then decision makers find it difficult to get information timeously and adjust their decisions. Information flows poorly, poor decision making happens, and the market doesn't adjust efficiently. The weakness in the market transmission mechanism can therefore amplify the movement of property cycles. In emerging economies, property markets are regularly affected by short-term shocks to the system and to the economy. And these typical shocks include sudden movements in, for example, commodity prices, interest rates, currency fluctuations. And these alter the course of the real economy, of the economy itself, and ultimately conditions in property markets. And so it is equally important to distinguish between the drivers of formal and informal property markets. Informal markets tend to be less integrated in financial markets, and therefore they tend to be influenced less by the macroeconomy and forces in financial markets. And that has to be compared to more formal markets, which rely on formal debt and financing, and are much more integrated what happens with the performance of financial markets. The overall stability of property markets in African countries can be improved by strengthening market transparency and ensuring that markets are better able to respond to market conditions as quickly and as efficiently as possible. In conclusion, property cycles are characterized by their length and amplitude, and also by the different stages of the property cycle, which have their own characteristics. While macroeconomic parameters invariably have a profound effect on the performance of property markets, these markets are also influenced by the decisions that players make in the user, financial, and in the development markets. So there's a growing understanding of the role of optimal timing in undertaking successful property development and investment decisions.